Stay tuned for Butler on Business, coming up next on the Liberty Express.
Jason, would you please introduce Pat Huddleston? I guess no relationship to you, Nick, as our next guest.
Pat Huddleston is the former SEC Enforcement Branch Chief, and today he's going to be talking, Alan, with us about investor fraud and Ponzi schemes.
Pat, welcome to the show, buddy.
Thanks for having me, guys. Happy to be here.
Now, you say that fraud wipes out more than $40 billion in nest eggs of investors each year. Could you tell us a little bit about it?
Yeah, that's right. And you can think of it this way. That's actually 2 Madoff's worth of losses every single year. And it just rages uncontrolled, and it's getting worse for some demographic reasons we might talk about. And what people need is a new way to think about it. They really need to know how we go about our due diligence investigations here at my company, Investors Watchdog. And what people traditionally have walked around with that old adage, if it sounds too good to be true, it probably is. And that's been sort of the extent of their the advice that they've gotten. And unfortunately, that adage is no longer viable and actually leads people into more fraud than it prevents.
Pat, what are some of the things people should be looking out for? And then tell them also about the services that you provide.
Sure. Well, I'm happy to do that. We actually describe in a book that's available now for pre-order on Amazon called The Vigilant Investor, and it's really a collection of what I've learned in more than 20 years in investor protection, starting at the SEC as a court-appointed receiver. The first thing they need to look for is their own thinking. If you've ever read anything written by Malcolm Gladwell or Jonah Lehrer, sort of the neuroscience of perception and decision-making, there's an awful lot of wisdom in that for investors. And so what I tell people is that you can't go into an investment or with an investment advisor and look for confirmation that they're telling the truth, because you will find what you look for. And frequently these guys work in teams. They have cohorts who will play the role of satisfied investor or successful business partner. What you have to do instead is teach yourself to look for fraud, because if fraud is what you're afraid of, you won't find it unless you look for it. And too often people take the wrong mental approach to the investigation, looking for confirmation instead of looking for a fraud. If you look for a fraud, you will look in places you would never look otherwise.
Pat, can I ask you this? I mean, how did the SEC miss Bernie Madoff?
There's no answer to that other than human negligence. They're a frightfully small agency with an incredibly big job, consistently starved for personnel and resources. But the truth is, that kind of regulation can't protect people to the extent they need it anyway. If you were to make the SEC 5 times bigger than it is, it could not protect people or sufficiently. They do good work, and they do keep the scam that's operating today from getting the investors it would have gotten tomorrow. But the truth is, they're like homicide cops. They show up and they look at the scrambled nest egg, and they may be able to bring somebody to justice, but they can't put the egg back together, if you know what I mean. So people have got to take it upon themselves to do this kind of investigation.
What are the typical financial fraud schemes that are out there right now? I think everybody knows about the Nigerians over there they're kind of like running away with it. Not that we don't like Nigerians, but.
Yeah, well, no, listen, promissory note scams are raging. I blogged about one today on my blog, Investors Watch blog, and it's just an epidemic. People agree to loan money to a certain business, and in return they get a promissory note, which promises them interest at a fairly reasonable rate, maybe a little attractive rate, but certainly not something that would make your eyes bug out and say this must be a scam. And so I tell people any investment that involves a promissory note, the safest course is just to stay away from it, because in most cases those notes are required to be registered under federal securities law, and they're not. And if you go into any investment that gives you a promissory note in return, you're taking a huge risk. The other thing that's raging now are pump and dump scams. You may have heard of those. This is where you're buying penny stocks. You're buying stocks that are less than $5 a share. Quite frequently, the companies behind those stocks are just shells, nothing to them. And armies of broker-dealers will go out and push these stocks, trade in the market in a way that bumps the price up. And once they've got the price to a certain level, they control all the stock. They sell out to the innocent investors, make a killing, and go on to the next one. So those are two that are just raging right now.
How are they particularly targeting senior citizens?
Well, they target seniors for a couple of reasons. First of all, that's where the money is, a lifetime of savings there. And secondly, because seniors, a frightful number of them, suffer from the beginnings of cognitive decline. The Mayo Clinic says 35% of people over 71 suffer from mild cognitive impairment, which affects their judgment and makes them rash in their decision making. And so people are all over the senior citizens. So where do seniors go? You can find them in church a lot of times. And so you get a lot of these scams that sort of rage through communities of faith. And if you get the first senior citizen, then you wind up using that victim to snag other senior citizens. People wind up bringing in their friends and their family. They're getting checks regularly, and they think, oh, wow, this thing must be real. Never once considering, because they haven't looked for a fraud, that those payments might be coming from somebody else's principal.
Now, how does the investorswatchdog.com, how do people who might have a suspicion or might not be suspicious, if they've been approached, how do they work with your website to tell them how to spot these things?
Yeah, well, the website alone, if you follow the blog, we give you advice, just general advice for free about how to spot these things and how to stay free of them. So what I would tell people is read the blog every day. You can spend 90 seconds, 2 minutes reading each blog entry, and you'll start to educate yourself about what these things look like. People think they know what a scam looks like, but they're thinking about a stereotype. They're not thinking about the real thing. So read the blog. If you want the real lowdown on the stockbroker or the investment advisor that you're thinking of using, you can call us. We issue what we call a broker snapshot report, summary report for $49, and it includes a search of records that have been expunged from the official database at FINRA, which regulates broker-dealers. And so we've got information that FINRA doesn't have, and plus we've got the experience. We've got decades of experience in this. We can take a look at somebody's background and give you a score, a safety score, which will tell you an awful lot. And then if you're considering a limited partnership or a hedge fund, something like that, contact us about getting a pre-investment investigation. Those things range in price depending upon the work involved in getting a complete investigation done well.
Well, Pat, what do you say to the investor that asked the question, well, why isn't the SEC protecting me? Isn't that their role? Isn't that their job?
Yeah, well, I would say it certainly is their job, and I think it's legitimate to hold them accountable. But what I would say to that person is that understand the police analogy, okay? The SEC doesn't have jurisdiction over stopping these people until the scams have already cranked up, right? So somebody has to be harmed before the SEC Enforcement Division has jurisdiction to step in and do something about it. So the question for the investor becomes, do you want to wait around and become that victim so that the SEC can then come in and do what it does? Or do you want to avoid being a victim? The SEC is not in the business of making sure you never fall victim to a scam. They're in the business of bringing to justice people who do rip you off. So if your goal is to stay free of that, now I should say there are a lot of great investor resources at the SEC's website, a lot of investor education you can get done there at sec.gov. But you should never think of any regulator as superior to your own education and intellect in the duty of protecting yourself from fraud.
Well, just looking through your blog a little bit earlier, I mean, the range of investor fraud, it really spans the spectrum, not just the typical what you'd think of like these pump and dump stocks that you've mentioned and things like that, but you even had an example of an art gallery featuring a prime example of a Ponzi scheme out in Oregon.
Exactly, yeah, out on the West Coast, Cannon Beach, if I remember correctly. And it's a great point that any kind of business can be the launching point for a Ponzi scheme. People oftentimes think, well, it must be a hedge fund or it must be a limited partnership. No, the case you're referring to was a guy who sold art out in Cannon Beach, Oregon, and he convinced people that they could invest in the business, and he wound up, just like every Ponzi operator does, taking one person's money and paying it to somebody else to make people think that they were actually getting a return. And here's the really dangerous thing. Not all of these people are career criminals. A lot of them are. There are a lot of sociopaths who occupy this space. But a lot of these people are just doing what humans do. They start out as legitimate investment advisors, lead people to believe they can expect a certain rate of return, And when they don't come through, when they're not successful in generating that return, they're like the middle schooler who has to bring home a bad report card. They look at that D and they think, oh, this is really unnecessary. With the stroke of a pen, I could make it a B. Everybody would be happy. I'll bring my grades up. Nobody will ever be the wiser. And so they just make that first bad decision. I'm going to cover this up. I'm going to send a phony statement, and I'm going to work extra hard this quarter and generate a return that makes it all true retroactively. So the question, the really tough thing is, how do you protect yourself from somebody who's never committed an investment crime, but who could if they just made one bad decision? That's how challenging it is. People tend to think that I just have to protect myself from career criminals. No. The career criminals are maybe, I would guess, a third of the people who wind up doing this kind of thing. The vast majority of them start out legitimate, make one bad decision, and then the snowball starts rolling downhill.
Well, Pat, tell our listeners one more time how they can get in touch with you and the services you offer at Investors Watchdog.
Yeah, thanks. They can get us at investorswatchdog.com. They can also contact us through thevigilantinvestor.com, which is the name of the book. Comes out in October, available on Amazon and Barnes & Noble now.
Pat, thank you very much. We look forward to having you on again.
It's my pleasure. I'd really love to spend more time with you guys.
Well, we want to have you on.
Okay, super. I look forward to it.
Thank you. This is Alan Butler, Butler on Business, and we'll be back with Peter Schiff after these brief messages.